So thanks and welcome everybody. Thanks for being here to our first session on geopolitical spillovers. We are running a few minutes late, so it's not all German punctuality here. I hope that is okay, given you had to run up all these flights of stairs. We will now start with the first presentation by Jacob Moscona. I hope it pronounced it more or less correctly, on foreign political risk and technological change. You will have 20 minutes, then we will have a 10-minute discussion by Ralf Ossa, who is on a Zoom call, and I hope he can hear as well. And then we'll have a 10-minute Q&A session. So, Jacob.
Thank you. Well, thanks all for being here. Thanks for including this paper in the program. I'm excited to present this paper, Foreign Political Risk and Technological Change, joint with Joel Flynn and Mai Wo at Yale and Antoine Levy at Berkeley. I think you could click the thing.
I need to click on this.
Yes. So it's no surprise that foreign political risk, international political tension can cause major damage to productivity and well-being, both because it can escalate into actual conflict, but also because it potentially threatens access to key inputs, resources, goods that are essential for production. And while there's growing interest in modeling how this political tension emerges and how restrictions to goods, things like trade sanctions emerge, there's relatively little evidence about how firms and countries react to these threats in practice. And one prominent possibility, which is what we study in this paper, is how innovation and technological progress reacts to foreign political threats, potentially reshaping and determining their eventual economic impact. And there are a range of different examples of this. So I'm going to start with one from the 2014 version of Elon Musk, who, when testifying before the US Senate, justified major investments in US space, basically saying that there's this rising political threat in Putin in Russia, and at the moment we're relying on the Russian government for all of our space shuttles, and there's the potential that that access gets shut off as the US and Russia fall increasingly into conflict. And so it's really important to invest in domestic capacity, domestic technology for, fast forward 10 years, this came up already in the introduction, but in response now to rising political tension in the US, political risk and uncertainty in the US, and potential threats to access of European access to things like defense technology, there's a real push to invest in innovation and technology and defense industries in Europe. So this is what we're trying to study in this paper. In particular, is it actually true systematically across the board that innovation reacts to foreign political risk? And if so, what are the mechanisms underlying that response? How can we sort of explain it? And second, if so, sort of what are the broader economic consequences of that reaction of technology to these foreign threats to production? So in the paper, we start with a model that I'm not going to present today, but it's a model of sort of firm-level exposure to changing foreign political risk and endogenous innovation decisions, and then sort of trade emerges in equilibrium. And the first key prediction is that greater exposure to foreign political risk increases innovation. And that's especially going to be driven by firms with middle levels of productivity who might, access inputs from abroad when we're in this good state of the world, but still want the ability to continue producing even when access to those inputs get shut off. And that's something we can actually test in the data. And second, maybe unsurprisingly, is that when this innovation response is greater, that's going to reduce your reliance on those risky foreign goods. So it's going to allow countries to better adapt to these changing exposure to foreign political risk. So what I'm going to start talking about today is sort of how we take this question to the data. And so the thing we need to do is compile a whole range of different data sources. First, on sector level data on technology development and investment and innovation. We're going to put together global data on patenting and R&D investment. We'll link to the sectors that are actually making those investments and developing those technologies. And we're going to link that with both patterns of trade and country by year measures of political risk and political turmoil that we're going to use to construct a measure of each country and sector's exposure to foreign political risk. And I'll talk about this much more in detail in a second. And the main results are basically going to be threefold, all kind of conveying that foreign political risk plays a major role in shaping innovation and technology development. First is that greater sector level exposure to foreign political risk substantially increases innovation, both investment in innovation and actually new patenting, new technologies getting developed. That's going to be particularly strong when risk emanates from geopolitical adversaries, countries where you might actually think this threat of cutting off access to goods or access to trade is most relevant or most likely to bite. And finally, I'm going to show evidence that this technological response actually mediates the consequences of foreign political risk. So in particular, this innovation response actually does reduce countries' reliance on risky foreign input as foreign countries become more risky. But at the same time, sort of interestingly to us, that really exacerbates the consequences of political risk for those countries that experience. So now you have this a period of political risk, political turmoil. Not only do you have to experience the direct effects of that, but now effectively the rest of the world is innovating you out of the trade network. And so even if you re-emerge from that episode of political risk, all this innovation has happened abroad that has sort of made you less relevant. Okay, jumping into the data and measurement. So I already mentioned a couple sources of data we need. First, we're going to put together data on innovation. The main source is going to be the universe of all patents filed in the United States, which we're going to link to, so where we know information about the technology class of that patent, the inventor, in particular which country the inventor is located in, and a whole range of other sort of patent characteristics that I'm sort of can talk more about if there are questions. We're going to have 2 units of analysis in the paper. The first, where I'm going to show you a sort of brief case study, is about critical minerals that also already came up in the introduction. So we're going to do one part of the analysis at the level of critical minerals, and we're going to link patents to the individual minerals, basically doing a keyword search to identify all the new technologies related to each of these minerals. And then we're also going to do an analysis kind of across all traded sectors, where we're going to again link patents to now sectors using existing methods for linking patent to technology classes to tradable sectors. We have other ways of measuring innovation if you don't like the patent data, and I can talk about that as well if there are questions. The second thing we need is a measure of country-level time-varying political risk, which we take from the International Country Risk Guide. This is going to be great because it's really long-running, so it goes back to the 1980s, and it covers a really broad set of countries, including things like expropriation risk, conflict risk, risk of rising religious tension. That's going to be our main measure. We can also validate that in a couple different ways and sort of replace that measure with other things that exist for shorter time periods or a smaller set of countries, and everything looks pretty similar. Finally, sort of for that piece of the analysis on sort of allies versus enemies, we're going to put together a couple different ways of measuring political alliances across countries, kind of at the country pair level, both from the Correlates of War project, but also using sort of revealed relationships across countries using UN voting data. And finally, it's going to be sort of an ingredient into a range of our measures is trade data. So at the sort of next 6-digit level, we're going to have sort of data on all trades. The main thing we want to measure for this analysis is a measure of sort of political risk exposure. First, the first part of the analysis is just focused on the US. So in this case, for a given sector and year. Oh, sorry. Should I keep going?
Sorry. No. Yes.
Great. Okay. And that's basically going to be, we're going to, for a given, so focusing on the US, say, oh, that's what. In words, we're going to sum across all foreign countries, interacting the risk level of that country, so the risk level of country C in time t, with that sector's exposure to that country. So in the case of minerals, we're going to define each mineral's exposure to a given country is just the deposit share of that mineral in that country. For across sort of all traded sectors, we're going to use a measure of sort of pre-period imports from that country C in sector I to the sort of focal country in question. And then, so that's going to be our main measure of sort of time-varying exposure of each sector to foreign political risk in each year, basically using sort of time-varying measures of political risk across all foreign countries and some baseline measure of each sector's sort of exposure to that country. Okay, so first sort of warm up, we're going to really zoom into this topic of minerals and critical mineral risk. So again, I already came up with the introduction, but minerals have become central inputs to many modern technologies, and sort of at the same time are concentrated. At least the mining of these minerals are concentrated in many politically volatile regions. So the first question we're going to ask is sort of, does mineral level innovation, now I is going to index minerals, respond to foreign political risk using the following estimating equation, which links innovation, this is patenting about mineral I in time t, to the political risk exposure of that mineral with mineral fixed effects, capturing changes in, say, demand for a given mineral, because they could be differentially useful for different production processes, and time fixed effects, capturing the fact that, a couple days ago when China threatened to restrict sort of global access to its minerals, that's kind of a time level shock that could really affect risk sort of across the board. I mentioned we're going to measure this political risk to minerals, summing across countries, weighting political risk in that country with the deposit share of that mineral in that country. And beta captures the response of innovation to foreign political risk. So even in this sort of specific case study where we can do a really good job linking innovations to individual minerals and tracking how that responds to risk, we see a big response, even at the annual frequency of patenting to mineral risk. If we aggregate everything at the decade level, trying to capture the fact that this innovation response can take time and maybe especially responsive to longer run changes in risk, you get an even sort of larger estimate by about sort of 50%. And then importantly, there's sort of no pre-existing trend. So you're not reacting to sort of there isn't a relationship between patenting and future changes in political risk, which suggests both that sort of the firms doing this innovation aren't anticipating this risk, but also that there's no sort of pre-existing trend in this relationship. And the effect is large. So a 1 standard deviation change in political risk leads to about a 30% increase in patenting as we measure it. And things look similar if you citation weight these patents or do a range of different techniques for measuring actually the quality or importance. Next question is, so that's one specific area of production, one really important sort of set of inputs, but does this generalize? Does a similar relationship exist across all traded sectors? So basically, to answer that question, we go back to the same estimating equation, except now I indexes all NAICS 6-digit sectors. And because we don't have this sort of convenient geographically fixed deposit share to weight foreign political risk by in this sum, we just use the import share from each country to the US at baseline, and sort of sum across all countries here. So when PRE is higher or increases, it means the political risk in the countries on which you rely for that particular sector goes up. Okay, and then again, sort of beta in this regression is going to capture the effect of foreign political risk on innovation. So this is like a big table. First, ignore panel A, focus on panel B for a second. So this is the one measuring sort of just focusing on that fixed pre-period import shares in the measure. You see an increase in the total number of patents, actually a pretty similar coefficient estimate, implying a pretty similar magnitude to the previous result. So about a 1 standard deviation increases change in political risk, increases innovation by about 30%. Similar if you sort of use a PPML specification instead of OLS. Similar result if you sort of citation weight or value weight these patents. So value weighting, basically looking at the value, the private value of each patent using the change in the stock market return of firms around filing, or other measures of sort of patent importance, driven by in large part sort of new firm entry as compared to an increase in innovation of existing firms. Although sort of this distinction kind of is not so clear across different sort of specifications, but across the board, across all sectors, an increase in political risk associated with more innovation in that sector. Again, larger effects when you go up to the decade level, thinking that innovation takes time to react and maybe more responsive to longer run changes in political risk, and sort of no evidence at all of an anticipation or pre-existing trends in this relationship. It's really this political risk change occurs and then innovation reacts. We do sort of a range of additional results, sort of probing what's underlying these results in the paper. Again, I'm happy to talk more if there are questions in the Q&A. But first, sort of consistent with that model that I didn't explain in detail, but sort of described, this is really driven by sort of middle productivity firms that might be especially responsive to changes in foreign political risk. The way to think about it is really productive firms are not really relying on foreign sourcing for a given good much in general to begin with. And really unproductive firms are kind of have no hope of developing new technology and sort of onshoring production, but it's these middle productivity firms that do this sort of insurance innovation, is what we call it, where that really seems to happen. We find a lot of evidence that it's driven by the private sector, and that this isn't really driven by sort of government investment or government response. It's really private incentives sort of pushing this in a variety of ways, and those results that I just showed you are probably underestimates because there's some evidence of sort of spillover effects across the production network. So if upstream sectors get hit, but you see some evidence of innovation. Okay, how am I doing on time?
You have 6 minutes.
Oh, great. Okay. So the next thing we can do is we can zoom out to the global. That was all US. Zoom out to the global level and say, does the same relationship exist at the global level? Where now we're running the exact same regression, except we're basically stacking across all countries. So now it's not just INT, it's ITC, where C indexes countries. And political risk we can now measure at the sector country year level. we're just exploiting the fact that different countries are reliant on different parts of the world for sourcing in each sector. The advantage of this is we can look across sort of all countries and start thinking about heterogeneity, but also we can include things in the specification like sector year fixed effects, just capturing, aggregate changes across sectors that you might worry sort of spuriously correlate with stuff in the previous regression. Here we can fully absorb that, fully absorb country-specific time trends and just baseline differences in innovation across sectors and countries. In general, only exploiting country-specific changes in political risk in the specific countries from which you source each sector. And again, we find this positive effect of political risk on innovation, including sort of various importance-weighted measures of innovation. Again, same story, no pre-existing trends, bigger effects over the long run, etc. More interestingly, now because we have this full set of countries, we can really try to understand which types of trade relationships are driving them. And sort of one hypothesis you might have is that it's, on the one hand, it could be driven by sort of any sort of risk of things going haywire in a foreign country. On the other hand, it might be stronger when political risk emerges among non-allies, because they're really the ones that might put restrictive policies in place. They're really the ones where a trade breakdown may truly be possible in response to political turmoil in those countries. Great. So we can basically estimate the same regression as before, except now measure this political risk exposure separately in countries that are your allies and countries that are your non-allies, basically just by taking the sum over using those definitions either from UN voting data or from the Correlates of War project, countries that we're going to define as your allies, and then include these two things, political risk for non-allies and political risk for allies, separately in the regression. And the answer is it's basically all driven by political risk for non-allies. So what really matters is when there's an increase in political turmoil, political tension in countries that you don't have strong political relationships with, that's really where innovation emerges. And there's actually a zero effect in the allied countries. So I'm going to skip this for time, but one thing that you can see is that what drives this wedge is really the sources of political risk where you think the government actually has control over it. So things like conflict, whether that foreign country is your ally or enemy, if there's an increase in conflict, that might sort of mess up your ability to source stuff regardless, and that country government doesn't have much control mediating the consequences of that, so you don't see a big difference between allies and enemies there. It's really these sources of political risk like democratic backsliding, military and politics, etc., that drive this wedge between allies and enemies, and that sort of makes a lot of sense, actually. One potential mechanism, which I'm not going to have time to explain in enough detail, that drives this relationship is that when sort of political turmoil emerges in your enemy countries, that's really where you expect breakdown of trade to emerge, because you might expect policy to emerge restricting trade, either because your country starts restricting trade with those countries, things like the sanctions and trade restrictions, or because they start doing the same to you. That's like Elon Musk's example of Putin in the introduction. Like Putin might start restricting our access to rockets. So we can test that. We can test whether the actual probability of a trade restriction emerging between two countries in a given year is in response to political risk, is different if they're enemies or not. And the answer is that the probability of me putting a restriction on a trading partner or them putting a trade restriction on me in response to political risk in their country, they both go up. So that's kind of consistent with this innovation result being stronger, anticipating the fact that these enemy relationships are really where trade breakdown is more likely to emerge. And you can see that there are a range of reasons why that trade breakdown might be more likely. One reason is policy, and you actually see that in the trade policy data. I think I have like 3 minutes probably. So I want to just kind of leave you with the fact that sort of this innovation isn't just sort of like, great, we can count patents, more patents emerge, but this is actually reshaping the sort of economic and trade consequences of political risk. So the first thing I want to show you is that there's big differences around the world in the extent to which this innovation response emerges. In particular, we can run the same sort of baseline regression, but separate markets that are doing relatively little innovation at baseline and markets where there's a lot of innovation going on at baseline. And this response is really all concentrated in these high innovation markets, both in terms of total patenting response and citation-weighted patenting, suggesting that markets or countries vary substantially in their ability to respond to these foreign shocks using innovation. That's one point. But the second point is that we can actually exploit that variation and say, well, if we're interested in sort of the trade consequences of, well, let me go here. the question is sort of, does this innovation response actually shape the trade consequences of political risk? So are countries actually able to reduce reliance on risky sort of sourcing country partners? The ideal but impossible experiment that you might want to say is, so you compare the effect of a political risk shock in a world where all this innovation is actually taking place, and a world in which you shut all that innovation response down. And you can't do that. What we can do is exploit the variation that I showed you in the previous slide, that high innovation markets are more elastic to foreign political risk than low innovation ones. So we can construct a measure of each export market exposure to this foreign political risk response, based on whether they tend to export to high innovation versus low innovation markets at baseline. And the hypothesis is that increased exposure to innovative export markets would increase the effect of political risk on exports. And so we can kind of test sort of this question, not by this ideal experiment, but by exploiting heterogeneous exposure to this foreign innovation response. Perfect. So what we need to do first is measure for each country and sector your exposure to foreign innovation. And that's going to be basically whether at baseline you're exporting to markets on average that are doing exporting to sort of country sector pairs that are doing more versus less innovation. And then we regress, how do my exports, I'm a country sector in year, how do my exports respond to foreign political risk? And how does that elasticity change when I'm exporting to countries that are doing relatively more innovation? And our hypothesis, if all this innovative response is reshaping these sort of trade consequences of political risk, is that phi is negative. Why? Well, I'm exporting to countries. I get this political risk shock. That reduces my productivity, reduces my capacity to export. If they're also sort of innovating me out of the trade network, that effect should be larger and more persistent. Because then even if my political risk shock ends, they've now built capacity through this innovation, and they're less reliant on my exports. And so rather than show you the table, I can just show you this in graph form. So this is that heterogeneous effect. There's a larger and persistently negative effect of my exports on foreign countries, especially when I export to foreign countries that are doing a lot of innovation. So that's evidence that this innovation is actually sort of reducing reliance of these innovating markets on risky exporters. But it's also kind of saying one explanation for why even temporary or transitory increases in political risk and tension can have long-run effects on my export performance, because now the rest of the world has effectively innovated away their reliance or need for me in the trade network. And that's sort of what this is showing. And these effects of this innovation effect is actually large, even relative to the direct effect of political risk. So I think I'm in stoppage time, but so hopefully I've convinced you that like thinking about innovation is really important for trying to understand the overall economic consequences of political risk, political tension. I've showed you sort of evidence of that in a variety of ways. And I think there's, this is only sort of a first paper trying to understand all of this, and there are a range of additional directions you can go, but I'll leave it at that, and really looking forward to the discussion and also any questions you have.
Thanks so much. We will now switch on. So we now stop sharing, and Ralph, it would be great if you can share your slides, and I hope this looks good.
I think this should work now.
Yes.
Excellent. Yeah, thank you very much for inviting me to discuss the paper, and also thank you for allowing me to participate virtually. Unfortunately, I couldn't make it due to a last-minute issue. So I think Jacob did a great job presenting the paper, so there's not much, so I don't want to spend much time summarizing it, but just to give you the paper in a nutshell, let's say, so the question that they're asking in this paper is how foreign political risk shapes domestic innovation and trade, and the mechanism that they're exploring is firms innovating preemptively, effectively to hedge against possible disruption of foreign suppliers, something that they call insurance innovation, as Jacob mentioned. Then they provide evidence at various levels, but effectively what they show is that sectors that are more exposed to political risk end up filing more patents, especially when the political risk is associated with a trading partner that is considered a non-ally. And the implication, or particularly interesting implication, I think, is that geopolitical risks drives directed technical change that reduces interdependence. So in some sense, it's a private sector channel of global fragmentation. So my overall assessment is that this is a really fantastic paper. I really enjoyed reading it. It's novel, it's creative, it's well executed. I think the idea is really elegant and of course also timely. What I found particularly appealing is that it really opens a new channel linking geopolitics to innovation and trade, which is anticipatory, which is private, which is endogenous, and in my view, a major step beyond the policy-driven fragmentation literature, which is of course also interesting and important, but it's just nice to see this kind of additional layer that this paper puts on top of it. Then I also think there's a pretty strong bridge between theory and empirics. Jacob didn't present the model, and the model is relatively simple, yet it gives insights that Jacob also alluded to in his presentation, particularly that the main response is coming from the farms that are in the middle, that are particularly exposed to this political risk, but at the same time also have a fighting chance of innovating themselves out of it. And then I think I already mentioned it, but it's really a new lens on fragmentation. It shows that decoupling can emerge without new tariffs, particularly through farms' risk-driven R&D choices, which adds micro-foundations to the debates on geoeconomic resilience. I have a number of questions that I would ask the authors, but to be clear, those are not questions I would all expect to be answered in this paper. As Jacob said, it's a first attempt, I think, to look at these issues, but I think it raises a number of interesting questions. So one question that came to my mind is, well, just a quantitative one. How large is the channel that they are highlighting? It's a compelling channel. I think I'm convinced after reading the paper that it's also a significant channel, but would be interesting to see how big of a driver of geoeconomic fragmentation it is relative to the more classic first moment trade shocks. Another thing I was thinking is that, of course, innovation is one response to deal with this political risk, but there's other responses. For example, you could diversify your sourcing structure. You could diversify not just from one, you could start sourcing not just from one supplier, but from multiple suppliers. There's also another obvious response, which is to stockpile, so to increase your inventory. And I'd be just interested to understand under what conditions firms choose innovation as their response, and under what conditions they choose other mitigation mechanisms, or whether maybe there's some complementarity between them. And then the last point, which I think is a question that I have more broadly for this literature, is I would really like to understand whether there's a market failure, and whether this insurance innovation, if you will, for farms that farms are undertaking is socially optimal, because of course this then determines the role of policy. I also have some additional reflections I'm triggered by this paper, but it's not so much comments on the paper, but I anyways wanted to share this as part of my discussion. The first point I wanted to make is that this paper, I think, really again shows the value of having a rules-based trading system, because it shows that it's not just a realization of trade policy shocks that matter, but it's also the risk of these trade policy shocks themselves. It's also the uncertainty, which means that it's not just important to have a trading system that keeps tariffs low, that keeps trade costs low, but it's also important to have a trading system that gives you predictability. And I think that's one of the traditional strengths of a rules-based trading system, at least as I see it. The second point, and I already mentioned it, but let me maybe elaborate a little bit. I think it's super important in this whole area to understand what the market failures are, because if you look at the policy world, my sense is a little bit that as soon as there's a problem, policymakers seem to think that they are part of the solution, and as a result, there's a rush to build resilience by governments, but often I think without a clear understanding of what the market failures are. And one thing that I'm thinking about, that's obviously a point that other people have also made, is that firms already have a strong incentive to build resilience, because farms are also suffering if supply relationships break down, for example. So it's not clear that there's a priori, at least, it's not clear that there's a market failure. I mean, one particularly compelling argument that I've heard for there being a market failure is the argument that basically there's a limit to how high prices can be in times of disruption. So say, for example, that you had invested in making respirators domestically during COVID, and then the trade shock comes and you can't import these respirators anymore. The equilibrium price would be extremely high, but presumably there'd be political and ethical limits on the price you could actually sell them for. And that, in a way, is a market failure that could that could allow you to make a case for government intervention that would require some public policy push to invest in resilience. But I just think it's important to think these things through. And the last point, even a more broader point, is that I'm concerned that this entire policy debate is always focused on strategic independence. So the goal always seems to be to become independent of politically risky trading partners. And here we see also that in this paper, we see that farms kind of are also thinking in the same direction. And of course, I can absolutely understand this. But from a trade perspective, I think what it means is that you end up investing in your weaknesses, because typically there's a reason why you import something from abroad. And I'm just wondering what happened to this idea of strategic interdependence that I think was guiding trade policy making for quite some time. If you think about European integration, for example, it was all about making France and Germany interdependent, and precisely because they were political foes and not political allies. So the logic was entirely different. So you wanted to be dependent on each other because you didn't get along politically. And the reason I find this attractive is because it would mean investing in your strengths. So rather than making sure that you're not overly dependent on a trading partner, you kind of try to make sure that there's a balance of dependence. Of course, I'm not arguing that this is something that is going to naturally arise as the laissez-faire equilibrium, but I think from a policy perspective, it's something that we should not forget. Thanks.
Thank you so much, Ralf Ossa, and we would give you a very short time to reply, and then we will open for question.
No, yeah.
And please use the microphone, either the hand microphone or thanks.
On actually, but is it? I think it wasn't. Whatever.
So I hope that Ralf was able to listen to your presentation before.
Yes. All perfect.
Just three. I mean, first of all, thank you so much for all those comments. It's super interesting and give us a lot to think about and sort of keep working toward. There's three things I wanted to say. So first, I think this question of this relationship between sort of, for lack of a better word, adaptation via innovation and adaptation via sort of reallocation or resourcing is super interesting. And those two things could be substitutes, they could be complements. This is something that also comes up in other work we've done on adaptation to climate change, where it's similarly, on the one hand, you could change think about agriculture, like you can change your technology by developing seeds that are more heat resistant and keep increasing your ability to produce as the sort of, heat apocalypse comes, or you could reallocate toward parts of the world that remain productive or are becoming increasingly productive. And those two things could fight against each other. Your incentives to innovate could be lower if you can easily reallocate, and vice versa. And of course, that decision too interacts with international political ties and the extent to which you actually want to or can rely on other countries for your food production, and this kind of idea of independence versus interdependence. I think, but there's no research on that, at least also in climate, about the relationship between those two mechanisms, and I think it would be super interesting. Second, this question about market failures and the extent to which the private market directs innovation in sort of the right way is also super interesting, and another area that is hugely important and about which there's almost no evidence, with one exception. I can make a plug for the AEA lecture from a couple years ago, written by the advisor to two of the four co-authors on the paper, Jeroen Assemoglu, which is called something like, does the market get the direction of innovation right? Trying to make a first attempt at answering that question in a couple different sectors, and kind of a plug for studying this. But there really hasn't been much empirical work trying to understand that question, and it's incredibly important. The third point I want to make is related to this last piece about independence versus interdependence. And I think one thing you can see from our results is that even small moves that governments make in either direction can have these cascading effects as the private sector responds to those changes in policy. So you can see from our paper, one of the reasons that private firms respond to foreign political risk is because of this anticipation of restricting trade policy, which increases their incentive to innovate and produce domestically, which further kind of, increases this decoupling or interdependence. And so that's an example where even relatively small moves toward independence on the trade policy side can have much larger effects because of the private sector innovation response to those policy changes. So we show that in that direction, but you could also imagine the same thing going in the opposite direction. And so I think thinking about these links between government policy changes in either direction, but then how that induces sort of a private sector response as incentives change is also really sort of interesting and important for thinking about these two directions. All right, sorry. And now I think questions.
Yeah, so I would suggest we take three questions, collect three questions, and then you will have some minutes to answer them. And my colleague will come around with the microphone. I see two questions. It should be on, yeah.
Okay. As long as it was.
So you say this is really coming from the private sector, and I wonder, just as more of a clarifying question, I mean, when the DoD gives money in the 80s to General Dynamics or now to Palantir, I mean, those are private companies, but they're clearly being directed by the DoD, for example. And so, are you able to see in the patent data that this somehow is like completely independent of the government in particular?
Yeah, so there are a couple different. So I think our ability to do that is imperfect, but we can do that in a couple of different ways. First is that.
You gotta collect.
Oh, should I collect?
But it's fine. If you keep it short, then we can do
Okay.
it.
So first, the first cut you can do is you can look at private firms versus the patents to non-private firms, and sort of it's all driven by private firms, but that doesn't capture the second piece.
Right.
The second thing we can do is in the patent data, you can identify patents that were funded by grants from the government, like government interest patents, and so you can see it's also driven by sort of, or it's slightly weaker, if anything, for these government interest patents, but certainly really strongly there for these non-government interest patents. Yeah, to a lesser extent. It's a little bit noisier because there are fewer, but yeah, it's a little bit there too. The third thing you can do is you can see that, yeah, there's no evidence of a difference between the two. The third thing you can see is if you just look across sectors at the ones that sort of the U.S. government has at least identified as critical, as compared to the ones that it is not identified as critical, you would imagine they concentrate their investments in these critical sectors. It's, if anything, a little bit stronger for these non-critical sectors as compared to the critical. It's not statistically distinguishable, but across the board, it really doesn't seem to be driven by anything that looks like public investment. It's really, and it's sort of as strongly there for these things that we really see that it could only really be driven by private positions.
Can we ask the second two questions? The two people raising their hands before.
But you can hear me. I was wondering, these are maybe something you said in the presentation, but just to clarify, you had these enemies. You classify countries as enemies to each other. Was it binary that you were only like enemies and friends, and did it change over time? And then another maybe a question on exposure. You maybe said it as well. I'm sorry. But how did you manage exposure to a given country? Was it just trade flows or FDI? Because it's a very different kind of risk. Thank you.
And I think there was a question right behind you. After
Probably there's some kind of opportunity cost here that might have resources some other area instead.
Great. So the first point. So how we measure what I showed was using a binary classification of ally versus enemy, just kind of a median split, but across three different definitions of how you sort of define allies and enemies. So one using the Coral to War project, one using UN voting data. And I'm sort of using sort of a measure based on sort of like all military and non-military alliances within countries. things look pretty similar if you're using a continuous measure. It's just like, it's easier to say like, two coefficients, one ally, one enemy, but like if you want to just do a continuous interaction, it's not going to make much of a difference. In the interpretation, changing over time, so we're using a fixed definition, and that's in part because variation in at least these measures over time is much smaller compared to just the cross-sectional variation, and it ends up sort of not messing like the numbers don't end up being that different, but just sort of we wanted to say we don't want any way in which if these relationships are evolving in part in response to political risk and innovation as well, we don't want to incorporate that into our measures, so we're just using sort of a fixed definition, but that's in part it's not going to make much difference. Direction versus levels. I think we would interpret a lot of this kind of as a direction, in part because empirically that's what we're able to identify, because we're always going to have sort of a time fixed effect or a country time fixed effect in the regression, which is going to be fully absorbing sort of in the only US, sort of how the level of innovation is changing over time, or total amount of patenting is changing over time, and then sort of in the country sector version, how innovation the country level is changing over time. If we wanted to like identify the sort of level change, you need kind of a more complicated model of that intercept and how that's changing over time. And that's tricky in the patent data just because the overall thing is increasing over time for lots of reasons. And so like I wouldn't know exactly how to discipline that model in a way that I'd be convinced by, but you need more structure in order to really say something about the overall level. Yeah.
So thanks so much to all the people asking questions. Also thanks to Ralf Ossa and of course to Jacob. And I saw there are many more questions, many more hands raised. Feel free to discuss over coffee. We have to move on, and we will now hear. Thanks. I'll hand this over to Tim. We will now have the presentation by Tim Meyer from the Kiel Institute. Yeah, you have 20 minutes, Tim.
Okay. So thanks a lot for having me. It's great to be here. So this is joint work with Nicholas, who's a PhD student at UBC in Vancouver, and this is my job market paper. So any kind of comments or feedback in this case is, of course, especially appreciated. So this is a paper about hegemonic competition. Of course, hegemonic competition is becoming increasingly important nowadays, and okay, can I click through?
Try.
Okay, I was clicking the wrong stuff. Okay, it's becoming increasingly important, and really since 2018, it's officially been the primary focus of US national security policy. And what they mean by that, of course, is they mean competition with China, which is now seen really as the main geopolitical adversary of the US. But of course, in the world, there's not just China and the US, there's many other countries that are having to choose their geopolitical alignment in this kind of a competition. And by now, there's ample evidence that this alignment matters. So we just saw a paper that's evidence that this matters for innovation, it matters for international trade, matters for international financial flows, and ultimately, of course, for international security in times of war. And so therefore, hegemons have been actively trying to reshape geopolitical alignment of foreign countries using economic carrots and sticks. So of course, in terms of carrots, for instance, you may know that China has really become the big elephant in the room when it comes to development aid around the world, and there's big policy concerns about what effects these payments might have. And in terms of sticks, of course, now we sort of see every week on the news that the US administration is threatening countries with tariffs if they don't comply with certain actions, and recently China, of course, also joined in on that. So in this paper, we really want to ask how effective these tools actually are at influencing geopolitical alignment of foreign countries, and also how they interact with one another, given that they're being used so widely. So now this is, of course, extremely hard to study, and especially it's hard to study in real time while this is just unfolding. So what we do in the paper is instead we go back to a historical time period where hegemonic competition was dominating world politics. So we go back to the Cold War to study this empirically in our laboratory, and then we're going to come back to the US-China competition at the end. So a bit of an outline what I'm going to do today. So first I'll outline very briefly the model that we use to think about these things in a more formal way. So there's going to be a model in which hegemons use payments. This is going to be the carrot. They're going to use these trade threads, which is going to be the stick, to move the alignment of foreign countries. So using that model, it sort of tells us how to think about these things more formally. We can construct measures of all of these things using historical data from the Cold War. So we put together this data set on these geoeconomic tools from the Cold War, and then in the third step allows us to estimate how effective these tools actually are in an instrumental variable set. We're going to find that in the end, these measures work, but it's pretty expensive to move countries aligned. So for example, if you double A for the US to a neutral country, if you move that country only 1% of the distance to NATO. So it's extremely expensive to move the alignment of countries. Final point, I'm going to come back to the US-China competition and study what perhaps might be the biggest change in development finance in the past decades, the shutdown of USA. We find that in response, actually China has decreased its aid. The rest of the world realigns away from the US to a modest extent, but perhaps US allies will be moving more than that percent. So I'll talk briefly about the literature. So we contribute, of course, mostly to this literature on geoeconomics that all of you in this room know. What I think we have to add is really, well, there's some theory about hegemons and how hegemons might do this stuff. Don't really know how effective this is in practice. How much can you move countries? And I think we're going to have some evidence on this to add, as well as a setting with two hegemons. So most of these papers concern how one hegemon might be doing this, and we're going to have something to say about how two hegemons are doing this, both in terms of theory and in terms of data. Okay, I'll jump right in, and I'll start with explaining to you a bit how we model this to just fix ideas and understand how you might even say stuff about these questions using data. So in the model, there's two types of that. There's hegemons and there's small countries. We're going to think of two hegemons, the Soviet Union and the US. They're using carrots and sticks. All the variables for the Soviet Union are denoted with snow. There's also small countries, and what small countries do is they choose their geopolitical alignment. And we're going to think of that as happening on a unit line. So on one end, you have the Soviet Union. On the other hand, you have the US, and countries can choose to locate anywhere in between those two. The game is going to unfold in two stages. So in the first stage, hegemons are going to be making payments to countries, and they're going to be making threats to countries. And the damage that these threats can inflict on countries, we're going to denote by power. So power is really how much hegemons can make countries suffer in terms of utility when they make threats to those countries using international. In doing so, what hegemons are going to maximize is the weighted sum of geopolitical alignment of foreign countries, where these VIs are just how geopolitically important the alignment of different countries is for hegemons. In the second stage, countries are going to have carrots and sticks on the table, and they're going to choose a geopolitical line. And in doing so, they're going to have some bliss point on the line where they would like to live, and hegemons are going to try to move them off them. In equilibrium, what's going to happen is the following. Where in terms of sticks, which are these straight threats, what's going to happen is that the optimal threat of a hegemon depends on the difference in coercive power. So you can think of what's happening in these kinds of models that hegemons try to extort other countries using economic power. Now, when there's a second hegemon, the difference to the one hegemon model is there's not an outside option where you could go and trade with other hegemons on the other side. So that lowers the extortive power of any kind of hegemon. There's some extortive power left, and that power depends on how the difference that your damage and the damage that the other hegemon can inflict on them. Additionally, hegemons may want to use carrots. We're going to model this following the literature on lobbying or on conflict, and the reason why they want to do this is because these carrots allow them to move countries where they don't have ability to move countries through economic. So this is going to yield a set of best response functions, which looks as follows. So this is the best response of the US to what the Soviets are doing. So you can see when the Soviets are doing very little, it's actually optimal for the US to also do very little. As the Soviets ramp it up, they also increase their payments. But if the Soviets keep pushing, at some point it becomes too expensive to compete, and the US sort of throws in the towel and decreases its payments. Soviets do the same, so the equilibrium is the intersection of these response curves. Here they're perfectly symmetric. It doesn't need, it's just easier to draw. Finally, countries are going to choose their geopolitical alignment. We're going to set this up so that it's particularly simple, where alignment is just going to depend on your initial preference pi, the carrots and sticks used by the hegemons, where these betas are how effective is money from the US and the Soviet Union, and the difference in force of power. So it's like you can think of this as being the balance of power between the two hegemons. So now we try to take this to the data and really construct a data set from the Cold War that allows us to measure these things. I think the Cold War is a really nice setting to study these kinds of questions because, of course, it was really a case where over 30 years, you had two hegemons trying to compete for countries. And the reason they competed for the alignment of countries, of course, is clear in the Cold War. What's top of the mind for a hegemon at that point in time is really security concerns, because there was a concern, countries might drift apart to the other side, and you could have rockets pointed at you or your allies. In this competition, where there's ample evidence, if we go through the paper, that foreign economic and military aid, as well as trade leverage, were the main tools of geoeconomics. So here you can see an example of what this means. So this is a dam that the Soviets built in Egypt, trying to curry favor with the Egyptian government in the 1960s. So now we're going to measure carrot sticks and alignment in the data. In terms of carrots, what we're going to do is we're going to digitize historical reports that have been declassified by the CIA. So what the CIA did in the Cold War is they really were meticulously tracking where the Soviets were sending their resources, where they were giving military aid across what's called the non-aligned countries, where the US was concerned that these countries might flip to the Soviet Union. We're going to assemble data from a similar data source for the US, covering, again, economic and military assistance by the US. So this is the picture of geopolitical competition using carrots or foreign aid in the Cold War. What I'm showing you on this map is how much countries are receiving from the US relative to the Soviet Union. So if countries are in blue, they're receiving more from the US. Countries are in red, they're receiving more from the Soviet Union. So there's a wide variation across countries. There's actually many countries which are kind of pink. So these are the kind of countries that extract payments from both sides. Think of India or Egypt in this map. So these flows are plausibly macroeconomically large. It's 2.5% of GDP. Of course, there's question marks about the GDP data for many of these countries, but to first order, this seems like a big capital. To measure carrot sticks, what we do is we measure the coercive power hegemons have over different countries. So what really matters in these kinds of models is how much economic punishment hegemons can inflict on different countries. We're going to measure this within a model of international trade that we calibrate the historical data. Within that model, we measure how much a country's consumption would drop if a hegemon were to punish it with tariffs. So you can think of this as a measure of the size of the stick. So that's the size of the economic dependency that a country has on a given hegemon. This is the stick of the US over different countries. So as you might expect, the US has lots of geopolitical power in Latin America, where countries, of course, are very dependent on trade, less political power the further you go away. If you do this for the Soviets, this kind of the opposite, of course, power in Central Europe, East Central Asia. Overall, of course, the Soviets have less power than US when it comes to international. Finally, we measure geopolitical alignment using standard sources. So similar to what Jacob was also alluding to, we're going to measure construct a continuous measure of geopolitical alignment using voting at the UN. We're going to rely on the ideal point measure from Bailey-Stresnev voting to do this. And so the thing that's nice is that during the Cold War, UN voting was really polarized between the US and the Soviet Union. So you see here in blue, I'm highlighting the US and its allies. Red is the Soviet Union and the Warsaw Pact. And really the great countries that are choosing their sides between are the non-aligned countries, and this is the countries whose alignment we're going to be. Now we try to estimate the effects of geoeconomic tools on geopolitical alignment. So what I had in the theory, and what's going to guide us in estimating this, is a reaction function of a country. So this function tells you how a country's geopolitical alignment is given by carrots and sticks in its initial processes. So I've told you nearly how we measure every component of this reaction function. I haven't told you how we measure underlying geopolitical preferences, which are going to be the main threat guided. So you can think that actually, in the world, the geopolitical preferences of countries are, of course, fluctuating over time. Hegemons' payments, of course, will respond to these kind of preferences. And that's going to be the main kind of indigeneity concern that we're going to try to address using instrumental variables. So we're going to run this as a standard panel regression with country and year fixed effects. And we're going to try to construct instruments for hegemonic carrots, as well as a balance of power between them. Here's the OLS results. I'm showing you first the normal just regression without any fixed effects. and then adding fixed effects and controls throughout the specification. So a positive coefficient here means more alignment with the US. So you can see that, as you might have expected, as countries get more money from the US, they tend to align more with the US. As they get more money from the Soviets, they tend to align more with the Soviet Union, which is reflected by these negative coefficients. Okay, so now the challenge here, of course, is that these tools are correlating with these geopolitical preferences. Now we're going to construct instruments that try to address these concerns. So to instrument carrots, which is 4 and 8 again, we try to follow the model. And what's really required in the model is a shift to the preferences of a hegemon. So remember, I was telling you that there's these parameters, which is the geopolitical importance of different countries for a hegemon, that are also perhaps fluctuating over. And if these geopolitical importance is fluctuating over time, that causes that hegemon to reshuffle its budget and countries to move, but not because countries' preferences are changing, but because hegemons' preferences are changing and they care about different countries. Now, I'm going to try to approximate this using a shift share instrument that leverages that countries are differentially exposed to fluctuation in the hegemonic aid budgets. Concretely, this instrument is constructed as the interaction of the overall aid to a world region that goes to a country in previous years, so that's the share, and the aid to that region in year T, which is the shift. So here's an example of the kind of variation that this instrument led. So for example, in 1969, Henry Kissinger starts to think, maybe Latin America is not that important anymore, and the US really slashes aid to Latin America. Now, of course, within Latin America, there's heterogeneity as to how reliant on US aid these countries are. And what this instrument is going to do, it's going to compare countries within Latin America that are more or less exposed to these shifts. And we're going to argue that these shifts in general, and this we go a bit more in detail in the paper why this might be the case, are not driven by any individual country in Latin America. So it's not Henry Kissinger is cutting aid because of Brazil or so, or any individual. In terms of sticks, what we're going to rely on is an exogenous shift in technology that shifted the balance of power over the course of the Cold War. In particular, we're going to rely on the decline of the cost of air travel. So this made it, of course, far easier to trade with countries that are very far away over the course of the Cold War, and that induced shifts in the balance of power and international trade. Concretely, what we do is we predict trade between different countries using a time-varying gravity equation, which is going to isolate the shifts in trade that are driven by shifts in air and sea distance. So these are really shifts in trade that are driven by technology and not by country preferences or country trade policies. Using these instruments, we're going to estimate the causal effects of carrots and sticks on geopolitical alignment. So this table shows you in the first row the OLS estimates, and then we add these instruments one by one, and then simultaneously. And we're going to find, sort of consistent with the argument that we've been making, that carrots and sticks indeed are related to geopolitical alignment in foreign countries, which is perhaps not surprising, but it's nice to know actually how big these effects are. So how big are these effects? So we find that buying alignment is going to end up being pretty expensive for hedging. So for example, what we estimate is that doubling aid to a country that's initially neutral moves that country by 2.5 standard deviation. So you can use different examples to understand what that actually means. It's like raising the odds of boycotting the Olympics by 5%, or it's 1% of the geopolitical distance. So it's extremely expensive to move countries very far. Alternatively, this is possible to move countries using trade dependence. So what we're going to estimate is that doubling US aid is kind of like increasing power over a country by 5% of Mexico's dependence on the US. So if you think, what does that mean? So another way of saying this is you take a country from somewhere around the world that doesn't trade much with the US, you move it to Latin America, becomes more dependent on the US, that country moves in its geopolitical alignment by around 15% of a standard deviation, so like 6% of the distance to NATO, just because of hegemonic power. Okay, so in the final part of the paper, we're going to use this machinery to do a couple of things. What I'm going to show you today is the consequences of a USA deep shell. Now, obviously, this is very hard. There's many things moving, and we see this as like a first quantification of what might happen in response. What we're going to do is we're going to extend all these measures to the present, and then we're going to calibrate the effectiveness of carrots and sticks to the estimates we have using the instrumental variables. and we're going to consider a shutdown of US aid. So through the lens of the model, you can think of this as a shock which sort of decreases US tariffs, perhaps because there's changes in geopolitical preferences within the US. The counterfactual then has two steps. The first step is to predict what is China doing in response. And the second step is how does geopolitical alignment change in response, taking into account both what the US is doing and how China is reacting and adopting. So for China, there's really two kinds of consideration when it reacts to this. So on the one hand, the absence of the US means you can actually achieve the same alignment for lower amounts of money. So you can decrease your payments and get the same alignment, which is good. But on the other hand, if you want, you can also push into countries and shift the country's geopolitical alignment if they're not already aligning with you. We find that on balance, what dominates is this first concern. So this is the Chinese reaction function across countries. You can see that in most of Africa, actually, China is predicted to reduce its aid by around 10%. This is consistent with some anecdotal reporting by newspapers. There's actually people at the Kiel Institute who are working on this empirically right now, and they seem to be finding similar kind of results. So it's not that China pushes in, actually it becomes cheaper to buy alignment. So there are some countries where China makes a kind of a push. It's mostly in Latin America, but in Eastern Europe, what these countries have in common is they're initially more aligned with the US. So those are the kind of countries where they're on the other side, and now we can try to push. What happens to geopolitical alignment? Not that much, because we don't find these effects are crazy large, but there is some of a move in geopolitical alignment. So the average country moves by around 0.303 units on the unit line. So that's not a crazy geopolitical distance. But of course, there's some countries which are moving by far more. And in particular, the countries that are moving the most are those who are initially more aligned with them. So this might, shoot yourself in the foot when it comes to your allies in terms of the units. Okay, so let me now wrap up. So what I think I've shown you is like a first attempt to answer these kind of big geoeconomics questions empirically using historical data. What I think we can take away from this is that from the perspective of a hegemon, these geoeconomic tools work, but they're expensive. So we shouldn't expect massive changes in geopolitical alignment to happen very suddenly just because of economics. In terms of the perspective of a small country, the findings in the model that we have suggest that there's some channels at work through which geoeconomic competition might not be all that bad. So in our model, it's actually good to have geoeconomic competition because it reduces the coercive power of a single hegemon. And if you're lucky, if in your small country, you can even extract payments from both sides because they become very interested. Now, applying this to the modern setting, what I think are two takeaways that we have, at least from the paper, are the following. So the first is that there's lots of policy concern about China's foreign aid and how that might influence the alignment of different countries and what the political consequence of this could be. The Chinese rise in global trade through the lens of our model allows China to influence geopolitical alignment without even sending any money abroad. And I think this is important to consider, and recent weeks are showing that this is important to consider. Second consideration is not necessarily the case that when one hegemon pulls back, the other one step in. So the dynamics of these kinds of conflicts are a bit more unintuitive than you may think at face. So I think there's many other things to do, and I'm happy to answer questions if you have.
And we will continue with the discussion by Mathias Thoenig. 10 minutes.
Okay, thank you very much for giving me the opportunity to discuss this paper.
It would be great if you can use the microphone for the people online.
I prefer to shout. Is it working or not?
Don't know.
No, it should be working for people listening online and for the YouTube. So I don't know how loud you can shout, but please use the microphone.
Good. Okay, so what Kim does in this paper is using modern quantitative tools to revisit a quite old and important question in the international relation and political science literature, which is the question on what have been the historical drivers of geopolitical influence during the Cold War, you know, between the two hegemons of that time, so Soviet Union and the US. And so they use, they work very concretely. What they do is that they use standard measures of, you know, ideology based on UN vote data, and they come up with this very fascinating figure, in my view, which is the time series evolution of you know, the ideologies, geopolitical ideologies of countries during Cold War. And what you see is that on the two poles, you have the US here and Soviet Union here. Okay. And in the middle, you have all the remaining countries. And basically, the paper is about how US and Soviet Union can use foreign aid or trade sanctions to attract those countries to their ideology. Okay, and so it's a story about moving those guys, those countries here from one on the other direction. And so basically, conceptually, it means that you can model the ideology space as at the one, you know, you have the US, at the bottom you have the Soviet Union without normative statement here, and there are intrinsic preferences of those countries that they call PI, you know, and ex post. There is some realignment, right? Okay. So you look at two tools. The first one is foreign aid. So that's a map that summarizes quite well what they do, is that it's a relative US aid vis-a-vis Soviet aid at the country level. And basically, aid in the model is modeled as transfer from the hegemon to the country, conditional on ex post alignment of the country. And this alignment is costlier. And the other tool is the threat of trade sanctions with those two maps, you know, the intensity of trade sanctions exerted by the US and by Soviet Union. And in the model, those, like in many of those geoeconomic models, you know, are off equilibrium threat. They never realize in the data, but still they allow hegemons to extract some concessions. And so the way they measure those sanctions is based on a simulation of a quantity trade model. Okay, and so it's basically based on the ACR 2012 model formula, and basically the power of the hegemon on I is the welfare loss experienced by the countries should bilateral trade be completely shut off, okay, between the hegemon and the country. So it's a quite radical assumption first. I will comment on that more. And then it's sensitive to the quantitative trade model used, but this I don't explain yet. Good. So they end up with this specification, which is the log of ratio of alignment. The higher it is, the closer ex post the country is to the US, the lower it is, the closer it is to the Soviet Union. That they regress based on a model, you know, on the differential of US aid versus Soviet Union. So you would expect a positive effect here. And the differential of power, so the extent of the threat that the US can exert on I, vis-a-vis the threat that the Soviet Union can exert on that. And here, so you would expect a positive sign. So, I mean, you know, using their model, but also common sense, you know, they discuss endogeneity problems, so they instrument those things, and they need to instrument both aid and trade sanction trade. So, you know, it's quite ambitious. You know, you need really two different radically different instruments. So that's ambitious, but at the same time you expose yourself, you know, to some critics. And in particular, I have quickly one. Broadly, I'm convinced by the exclusion restriction, the causal effect, but still, I want to challenge you a bit on that. You know, first, I would like you to maybe in the paper to explain better why power is endogenous. I think it's a bit less obvious. But still, you instrument it with a gravity-based instrument, you know, which is really which is quite standard with the trade data, but still quite elegant. They use historical evolution of airline costs as a way of measuring how each country and gets closer to each other. But of course, you can think of the fact that if airline cost goes down, then not only trade intensify, okay, which is your channel. And so because trade intensify, the cost of disrupting trade will be higher. At the same time, migration flows increase. At the same time, some Egypt is sending students to study in Moscow. Okay, and so your migration flows, and we know from the trade literature, from migration literature, that you have cultural remittances. Hilal is here, he can document all those things. So and this also participate to ideological realignment through another channel, which is not the one you know. So I think you're a bit at risk of exclusion and restriction violation. Okay, basically they end up with a nice table. Results are okay, a little bit fragile. Maybe you're working on that. Okay, overall, let me congratulate you. It's a fascinating research project. It's it's done by 2 PhD students, and I think it's a very promising GMP. And the GMP spirit, it's really, you do a showcase. You do a showcase of applied theory that you combine with data. You do counterfactual simulations. Your data collection efforts that you should today is quite impressive. So you have a versatile, creative, quite compelling IB strategy, use of frontier techniques in applied econometrics. So I don't know what is lacking, maybe a bit of behavioral economics. That's quite impressive showcase. Of course, it's still in progress. Of course, the writing can be improved. The model exposition, I must say, is not super transparent, and a bit more. My concern is a bit more about the interpretation and the intuition. Sometimes so yeah. Anyway, it's a very rich and insightful paper, and I encourage you to consider because you want to know more. A 20-minute presentation does not make justice to the richness of your paper. Good. Okay. Now, just one point first. You should, I think you should improve the position of your contribution with respect to the existing literature. The way you model carrots and sticks really echoes the theoretical contributions of Chris, Jesse, and Mathias. And also the way you model the 2 hegemons using trade sanction and with alignment equals what Fernando and Christophe have in the paper. So I think you should clarify a bit the perspective here. My perspective is that you're facing a trade-off of, okay, you accept to do a less realistic model than what they do, those guys, but you gain a lot in terms of tractability. But I think if you agree with me, maybe it's a small achievement, but if you agree with this statement, you should emphasize it more. However, if I'm right, you may want, in particular, I see your model as a special case of the Maggiore et al. Clayton, Chris is in the room, so Chris, Clayton, Schreger, and Maggiore, sorry, paper, a theory of economic coercion and fragmentation. In my view, it's a special case, but they are not able to put this huge and rich framework that they develop to the data. You simplify it and you put it to the data. So if you're okay with that, then maybe the way you built your paper should reflect a bit this strategy. Relegating your model to the appendix entirely, or even starting from that framework, showing how you simplify it and what you gain out of those simplifications, and you gain that in tractability and the ability to test completely the model. Okay, good. Counterfactual simulation, it's very cool. Like you made very clear, they estimate the framework on Cold War, but they extrapolate all the things to the current hegemonic competition between China and the US, using a very timely policy scenario, which is a shutdown of US aid last spring. Super cool. The results actually are not so intuitive, right? They show that quantitatively, China responds to the shutdown of US aid by decreasing its own aid. It's really, you learn a lot from the model, right? And you have a compelling theoretical explanation of that. Super cool result. Yet I think my question, is it reasonable to estimate the model on Cold War and then perform counterfactual simulation on US-China in the 2010s. I think you should discuss the robustness of the parameters, time varying, the stability across decades, you know, your parameters. Okay, good. Then two unaddressed channels. I think the one big channel that you don't address is trade policy. Of course, it's quite. I mean, it's quite likely that historically, US and Soviet Union have used their trade policy also to force realignment of countries. You don't discuss that at all. In particular, in your model, you know, the measure of trade threat is just each country, each hegemon takes trade dependency as given, and the threat is about shutting down completely the bilateral trade. And so it means that in reality, trade dependencies, you know, affect the gap between the inside option, which is on equilibrium trade with between the hegemon and the country, and the outside option, which is the off equilibrium trade sanction. And both the hegemon, and I think that's very crucial here, trade policy is used by both hegemons to raise the gap between inside and outside option, and by each country to reduce dependency to the hegemon to reduce the threat. Okay, and so I think it's very important that you discuss this omission, or how this omission, both in your theory and in your affect both your theory and your empirics. Okay, is causal inference at risk? Not considering trade policy? Could you do a horse race between foreign aid and trade policy? You know, and last, I finish with that. I think it's maybe I would like to know that. You know, do you think that it's not for the paper, but question to you? Do you think that historically this competition between US and Soviet Union, you know, with foreign aid, contribute to maintain the war code? In other words, diffuse geopolitical tensions and avoid escalation. Okay. And then, I mean, the answer would require you to endogenize the probability of conflict between Soviet Union and US, but I think it's really out of the paper. But I tell you, quantitatively, we have a paper with Isabelle Méjean and Thierry Meyer, where we show that the manipulation of trade dependencies between US and China in the 2010s massively changed the probability of conflict between them, and also the geopolitical power of the US. Okay, so what you see in the data is that historically, since the mid-90s, US has become, in the data, much more dependent on China as an export market and China as an import source than China was. Okay, so there has been an asymmetric evolution of trade dependencies between US and China. As a result, still, they have historically the coupling between the two economies has increased, yet in an asymmetric way. So that if you compute the probability of conflict has decreased, so the probability of de-escalation of tension has increased as a result of this coupling of the two economies. However, because this coupling was asymmetric, the model, when you quantify it, shows you that US lost 0.2% of real consumption as a result of its decreased bargaining power vis-à-vis China. And so trade and policy matters in geopolitical competition and affect also your measure of power. Thank you very much.
Thanks. Tim, you want to respond very quickly? And then we will collect 3 questions again and give Tim some time to answer them.
Yeah, okay.
Very
So
quickly, Tim.
But first, of course, thanks a lot, Matthias. Really great points, and very much appreciate the discussion. So to address a bit the biggest point. So first of all, how to think about the endogeneity of trade policy. So right now in the model, we just say, you know, trade is happening, and then given that trade looks like something, how do you leverage that for threats? So we don't endogenize that hegemons are actively reshaping this, and this is why we use the instrument, because we know that the world is more complicated than the model we write down. So we've worked a bit on, you know, how this might affect things. So actually more on the side of small countries. So the interesting thing here is that normally what happens in these kinds of models is that small countries want to deglobalize because they don't want to be threatened by hegemony. And what happens in this model, like tentatively, is you actually kind of want to balance the two hegemons. So it's not clear that you just want to deglobalize. You're perfectly happy to trade with both of them as long as they sort of can threaten you equally well, because then they cannot extract something from you. So second, on sort of realism and how do we think, like how serious should we take this now? So, I mean, I think we should take all of these numbers also on the US-China thing with a grain of salt. We can probably do a bit more robustness regarding, what happens if we vary these or that parameters. We do a bit of that in the paper. So the finding that I think is really robust is that it's not optimal for China to respond by increasing. So because it's just the fact that if you look at these alignment measures, it seems that everybody's already kind of very aligned with China already. So it's really, it doesn't make much sense for China to increase its foreign aid. It could also be a bug of the alignment measures, of course. What's a bit less a question, more depends a bit more on the parameters is how much countries are moving. So what we do in the paper is that there's some estimates of how much US aid was actually cut across different countries, and we plug those in, and those would lead to, of course, to a bit different. But yeah, thanks a lot, and yeah, I'm happy to take questions.
And there was one question in the first row, a second one, and the third one in the last row.
Thank you very much. Very interesting paper. I have two questions. One is about you have data, and if you look at military aid specifically. And the second question is, if I understand well, you focus on the bilateral links between hegemon and two countries. Have you thought about, the spillovers of the group of countries and the fact that the hegemon game may be to build coalition of countries, and therefore, these countries trade more with each other, security agreements, etc. So the kind of group dynamics there, which also makes it more costly for a country to degrade.
Yep. I'll take all of them and then.
My question regards the study. So of course are not basically the full set, basically full set of the disposal of the hegemon. So like probably the US overthrew most countries in Latin America at some point. I was wondering, given that some of these tools are clearly complements, if you somehow seem to be relying on that basically your instrument is completely basically gets rid of any potential correlation between these, which is not obvious, where like if your trade power shrinks, you might want to consider military intervention more likely or whatever. So how do you think about it? I had a similar question about data. How terrible Syria estimate for the US and critical data for the United States are. So, like, I imagine the CIA does not care about the massive conflict of the US or like military, for instance, whether the critical does or maybe not. I mean, still sometimes you find one actually.
Okay, so I'll take everything in once. So to okay, so to answer the question, so first military aid, it's in there. It's an important part, especially in the quote. Second point, you had spillovers. So we cannot do it in the theory yet. We've tried, but so far haven't been that successful. We can do it empirically. It seems that these spillovers are not too large. So what happens in the Cold War is you can think there's actually many countries that are kind of very similar that do radically different things. So if you think about Central America, there's like Costa Rica, Nicaragua, El Salvador. These countries end up doing very different things. That sort of points you into the direction that spillovers are not too large, and we have a specification in the paper which allows for spillovers, and we also don't find that they're too large. Okay, Carlos' point, other tools being used. It also goes a bit to Matthias' comments that I forgot about, how do we think about actual war? So this is a very peaceful model in which, hegemons use trade and some foreign aid, but there's no the sanction never realizes and war never realizes. So we think of those as being sort of alternative tools that are in the error term. In practice, we're going to be able to control for much of this. So we have specifications, for example, where we control for measures of CIA interventions in different countries. So that's how I think of these that are sort of omitted variables that are also being used by the hegemon. And that's how we try to deal with them as best we can. And we're thinking about how to make more progress on this. Okay, different kinds of military aid programs for the US. So what we did is we tried to really get sort of as much we can. If you have more ideas or more data that might not be included in the ones we're using, we're very happy to take it on and include it, because sort of, I mean, it's kind of the goal to really capture the full array of tools that hegemons are using as best we can. But yeah, thanks a lot and very good questions.
Thanks to all the speakers. So we have a short break. So move downstairs to the coffee and then to the keynote by Kenneth Rogoff, please.